Thanks for tuning in to this week's investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start off with our chart of the week, and we titled this one Fundamentals Driving the Magnificent Seven. So there has been quite an uptick in market concentration here. In other words, a relatively small amount of stocks makes up a large part of the index now. And that's what we're showing in the blue bars in the top clip is the so-called Magnificent Seven or the Mag Seven stocks now comprise 33.1% of the index, so about a third of the index, which is up near a record high for these seven companies. And so that may feel a little bit frothy for those names, but what gives us some comfort is that the earnings have really been what's driven the trend. So that middle clip, the orange bars, show the percentage of earnings that the Mag 7 makes up of the S&P 500. So you can see that that's actually 27.1%, which is not that far from the 33% of market cap that these companies comprise. So what's important to note is that fundamentals have driven the trend in the market concentration here, and we would be more concerned if these started to diverge from each other. So if market cap continued to escalate while earnings started to soften as a percentage of earnings in the S&P 500. Thus far, the two series are confirming each other, implying that the move in the Magnificent Seven is backed up by fundamentals. Now, last week was another solid week for the markets. You had broad-based strength, but what's really been notable is this move in international markets thus far this year. Emerging markets are now up about 21%, and developed international markets are now up a little over 24%. And you compare that to the S&P 500, which is up a very respectable 10.5%. And small cap stocks are now positive on the year at 3.4% as well. But you really can see that there's been some pretty solid international outperformance this year. Now, that's an area of the market that we made sure to rebalance to earlier in the year. So last week, the big data was on inflation. And so what we're showing here is we're showing the consumer price index in orange in the bottom clip, and the top clip is the S&P 500. Now, inflation did tick higher. Inflation moved up to 2.7% for headline inflation, and core inflation, which strips out food and energy, did move up to 3.1% for July. So those are pretty far from the Fed's targets here, but it's not yet problematic for the stock market. So what this analysis shows is that it really doesn't become a problem until the consumer price index rises relatively far ahead of its 6-month average. So right now, the 6-month average in inflation is 2.5%, and CPI itself is 2.7%. So this would imply that you need a rise up to about 3.1, 3.2% in the consumer price index itself before it starts to become a more major headwind for stocks. And we're just not there yet. Now, not all is great on the inflation front. So I did mention that consumer price inflation did tick up, particularly the core inflation, but producer price inflation kind of made firework headlines last week when it came out. We saw pretty large jumps in producer prices. And a lot of people interpret that as producers are eating the tariffs because CPI is lower than PPI. But that's not a correct interpretation. What PPI measures is it measures the prices received by producers through various stages of production. And what was driving the jump in PPI last month was an expansion in trade margins. And so what that tells us is that producers probably did sit on price increases for a number of months until they started to get a feel for what the final tariff rates would be. And then there in July, they started to pass those price and costs on, and that resulted in higher margins in the PPI calculation. So what's notable about this is CPI did pick up last month, and PPI does tend to lead CPI. So higher PPI price inflation means that it's a little more likely that we end up seeing higher consumer inflation in the upcoming months. Now, consumers could feel that. So we got the University of Michigan Consumer Sentiment Index update last week as well. And we're showing that in purple here, but we're also showing expected change in the inflation rate over the next 5 years from consumers. And you can see that consumer sentiment dropped a little bit and consumer expectations for inflation picked up last month. So that is something that's notable because tariffs can be just a one time price increase unless inflation expectations begin to anchor higher. And if that's the case, then you need to worry about a little bit more persistent inflation. So, not the end of the world today. It's just 1 month. But we did see a downtick in consumer sentiment and an uptick in inflation expectations, both of those moving directions that we'd rather see them go the opposite way. Now, when we got the retail sales report at the end of last week, we would note that consumers are absorbing the trends here. These three clips measure discretionary consumer spending. And you can see on that score that last month was broadly positive across discretionary consumer spending. So consumers haven't yet balked at higher prices, and they're still out there spending, and that's supporting the economy and corporate earnings. Now, a rate cut is likely coming in September, and that would be the first rate cut after a long pause. And our friends at Ned Davis Research went back and studied what's happened to the market before following long pauses where the Fed finally started to cut again. And you can see here, this is that pattern. This is the average of the index. And you can see that the markets tended to perform well starting about 3 months before that cut. So this could prove supportive for the bull market. Moving on to the earnings picture and the fundamentals, the Q2 earnings season is turning out to be quite strong. It looks like earnings grew over 10% year on year, and the percentage of S&P 500 index companies with positive earnings surprises is north of 81%. That is a really healthy reading for earnings. I think what happened was analysts following Liberation Day were really quick to cut their earnings expectations for companies, but companies have been able to manage the tariffs a lot better, and they've come in and surprised to the upside from an earnings perspective and earnings relative to expectations. So really strong earnings season. That's helpful in preserving wages and jobs and economic growth. So good to see from that perspective. Now, we would still give this bull market here the benefit of the doubt for a number of reasons. One, the economy is still powering higher. Interest rates really are not that historically high. Inflation is not that much of an issue right now. And simply put, this chart's just showing a composite in orange of different indices either trading above or below their moving averages. And you can see here in green, those are the things that are positive for the market, that those are tailwinds for the market right now. The S&P 500 itself is trading higher. High yield corporate bonds are trading higher. The Nasdaq's trading higher. So is the Dow Jones Transport and Utilities average, and crude oil is trading lower. So those are things that are supportive to the market, and we'd still give the bull market the benefit of the doubt. All right, so our closing thoughts for this week. The chart of the week was on the fundamentals and how they've driven the Magnificent Seven to great heights. High market concentration would be more concerning to us if it diverged from earnings, which that just really isn't the case right now. And last week, we did see another solid week of returns, and international stocks continue to lead the way for the year. That's really been a theme for 2025. Now, consumer inflation did accelerate in July, but it's not yet an issue for stock market performance, something to keep our eye on. However, rising producer price inflation, that does suggest that there could be more upside here in the upcoming months in consumer prices. So that's something for us to keep an eye on as well. Now, consumer sentiment did tick lower on higher inflation expectations. So again, something to watch there. But the hard data on retail sales does suggest that costs are thus far being absorbed just fine from the consumer. Now, a September rate cut is still likely and it could support the bull market in upcoming months. And then some other trends that we're seeing, like for instance, oil prices being lower, and the market's trading higher than their moving averages. Those things are supportive of the bull market, and we continue to give the bull market the benefit of the doubt. So that's what we have for you this week. And as always, I want to thank you for joining us and wish you a great week ahead.